Welcome back to another video for HarborFinancialOnline.com. Today I'm going to be talking about capital gains tax on stocks and if you owe tax when you sold your stock. So what I'm going to do is explain this in a way that simplifies the process for you guys and hopefully helps you out. So let's get going here in the video. So you must report the sales of all stocks that you make during the year. So it doesn't matter how small the sale was, you still, by IRS rules and regulations, have to report this on your tax return. Okay? You must report the exact date you purchased and sold the stock or stocks. Usually these dates are going to be found on the broker statement at the end of the year that's mailed to you, or you can go into that broker's website and usually download those dates, that form. Because the dates are really important when it comes to your tax information. You have to report the exact date you purchased, the exact date you're sold, and you can't. That's an area you can't make errors on. Okay. Now sometimes you bought. Let me try to explain this in an easy way for you guys to understand. You bought the same stock on various dates at different times, so on your tax return you're just going to put various instead of all the dates. You can do that sometimes. So that's depending on the software you're using, it'll allow you to put various. All the sales are reported on Schedule D, which I'm going to take you to later in the video, and we'll walk through Schedule D together. Make sure on your stocks, if there were any stock splits, you're going to have to report this a little bit different. So if there's a stock split, that's going to change your cost basis for the stock. So you need to do a little investigative work and see if there were any stock splits over the years that you own that stock. Usually you can just go onto the internet and do a search for that stock, put in stock splits, and it'll tell you if it had any. Stocks are divided between short-term and long-term on your tax return. If you own the stock for 1 year or less, it's going to be short-term. More than 1 year is long-term. Now, the higher tax rate is going to be for short-term stocks. The reason they have it like this is because they don't want to penalize investors that are owning stocks for a long period of time, over 1 year. But the investors, traders that are owning stock for short periods, less than a year, they're buying and selling, then they're going to have the higher tax rate just because it's not necessarily an investment, it's more of a trader activity. If you had a loss on the stock of a sale of a stock, you're allowed to write that off, but there is a maximum amount. You can write off $3,000 per year. And how this works is if you had a loss of more than $3,000, you're allowed to carry that back to other years to offset gains or carry it forward to future years. So it's easier to carry it forward because if you go backwards, then you'll have to amend that old return, where if you carry the loss forward, any future gains you can offset with that amount above $3,000. Okay? Now, what I recommend is trying to time the sale of your stocks. Like I said, if you had the stock for more than 1 year, it's going to go into a long-term bracket, which means it's going to be lower taxes. So if you can own that stock to get over the 1 year and then sell it, I would highly recommend that. It's going to cost you a lot more to sell it if you owned it under a year. So let's take you to the Schedule D real quick. This is Schedule D. This gets attached to your 1040 if you sold any stocks during the year. It's not going to be attached if you didn't sell any. Say if you just bought stocks, this isn't going to get completed. Again, the dates I told you about, this is where they want the exact date, exact sales price, cost, basis. The basis, this is going to come to affect your cost. Remember, if you had a stock split, so you need to really look into that. It's going to change the overall cost of your stock. So the top part is for short game, 1 year or less. Okay. Part 2 is going to be more than 1 year, long term, a lower tax bracket. So if you can get into part 2, if you can get the stock to qualify as long term, you're going to be a lot better off. If you do the return online, it's going to automatically bring in this form Schedule D and fill it out for you. It's just going to ask you some questions and you answer them and put in the amounts, but it's going to populate all these boxes and submit this form when you file it. So here's our website, harborfinancialonline.com, and we have a lot of great things on tax here that I recommend you check out. It's gonna really simplify the tax process for you and show you different ways to increase your refund, how to get all the deductions out there. You can see on the left side here we cover all areas of tax. Capital gains tax law explained right here. We have a full page dedicated to this, so I recommend checking that out. The holding period, that's what I just talked about, short term, long term. The different tax rates. Again, long term is 15%. That's what it normally comes out to. Short term is 35%, so you can see a big difference there. So I hope that helped you guys out with the sales of stocks and how to report it. If you can keep that stock for 1 year or more, you're going to pay a lot less tax. You're going to be in a 15% tax bracket normally. Less than 1 year, 35%. So that's why I stress that. Again, thanks for watching the videos. We have lots of other videos out there on YouTube. I recommend watching some of those. Different ways to increase your refund. And check out our website, harborfinancialonline.com. Thank you.